Investing can be very overwhelming, especially when it is your hard-earned money that is at risk. So today, I'm going to explain to you how I go through the process of picking a company that I am looking at to invest in the long term. I am in no way a financial advisor, so please take everything I say with a grain of salt and do your own research. Keep in mind this process is different for everyone, and if it does not work for you, that's okay. I'm just trying to help those who may need a little push in the right direction. But for now, let's get started with the video. If you are new here, please hit that like button and subscribe so you don't miss any more content like this. And if you're really feeling up to it or have any questions, hit the Discord link in my description to join my Discord. Now, when you are first starting off, I would recommend that it is smart to get into an index fund. By doing this, you will have exposure to the majority of the markets, and there really won't be much stress on you having to pick out which stocks are going to perform well over the next few years. But let's say you get tired of these index funds and you've been observing the markets over the past few years, so you want to take initiative and invest into a company that you believe in. Well, here's how you should go about doing so. The first thing we want to focus on are your goals and how much you are willing to put aside to invest. When we look at investing, it is usually done over a long period of time and does take a lot of patience. Many people have come under the impression that the stock market is a get-rich-quick scheme, and I can assure you that it is not. As said best by Warren Buffett, the stock market is a device for transferring money from the impatient to the patient. When you're starting a stock portfolio, you want to outline how much per month or week you will be putting aside from your total income, and if you are looking for an aggressive growth or a more steady style of investing. The entire goal of investing is aiming to minimize risk and maximize gains. When people start out investing, they usually tend to go for the high risk, high reward plays, which is where penny stocks tend to step in. I get it. You found this $1 stock and you think it's going to become the next Amazon. And you know what? Maybe it will. But I'll be honest, 9 times out of 10, most likely 9.9 times out of 10. I hate to break it to you, but it isn't. Penny stocks are so easily manipulated by big funds and institutions, it just isn't worth it. When you're starting out investing, it's better to go for companies that have been able to show profit and consistent growth year over year. Now that we've got penny stocks out of the way, we need to understand the company's float and how they are priced on today's market. The two types of shares we will be focused on today will be shares outstanding and free float. A company's shares outstanding are the total amount of shares that a company has issued, while a company's free float is the amount of shares that are currently available for trading. This is important information, as a stock with a smaller float tends to be more volatile than a company with a larger float. This is a common misconception that so many people have when originally starting out with trading. For example, why is Apple only $130 a share, but Amazon is over $3,000 a share? Well, Amazon has 500 million shares outstanding, and Apple has 17.6 billion. The more shares a stock has, the slower it moves. This is important while playing stocks and options. If you're expecting a 4-point move on a stock like Amazon, it is much more likely to happen than a 4-point move on a stock like Apple. This is because for Apple, to move 4 points, there has to be much more buyers due to the large float to push the price up $4, compared to Amazon that doesn't have as big as a float. One way that you can find this information is finviz.com. I'll leave a link in the description, and you guys will be able to go to this completely free site where you can go to the search bar, type in any company, and a lot of information will come up at first. But when we're looking at float, these are the two boxes that we're going to really want to focus on. And as we can see, these are the shares outstanding, which is 17.06 billion, and the shares float, which is 16.63 billion, and this is for Apple. And this information is available on every single stock that is traded in the markets for free. One more thing you should know when looking at a company is the bid and the ask. The bid is what buyers are willing to buy the stock at, and the ask is what sellers are willing to sell the stock at. Usually on low float companies, there isn't much volume, and we see these bid-ask spreads widening, which makes the stock harder to get in and out of. Now that you know how a stock is priced, let's go on to the fun part, choosing which stock to invest into. Trying to choose one stock specifically can be a nightmare. So, in order to break it down, I would recommend first looking into an industry that you are familiar with. It is good to know the sector that the company you are investing in. One easy way is to find a company that you work with or use on a regular basis. When we are investing, our goal is to find an upper edge to be smarter than other people investing into this company as well. One easy thing to do is take something that you do every day and are familiar with and invest into that. For example, let's say every morning before school and work, you go to Starbucks and you realize that there is always a long line to get your coffee. And it seems like you are paying a pretty decent amount for flavored water. Well, look at that. You just came up with your first investment idea. Now, how do you confirm that Starbucks isn't a failing business and has good financials? Well, as you can see on my screen right now, I have Morningstar.com. It is one of my favorite sites to easily access simple financial data from companies for free. Right now we're on the home page where it'll give you a little recap of what the markets did today and some news to follow along with it. But what we're focused on is going to the search tab and searching up the company that we want more information on. And in this case, it would be Starbucks. The US securities usually pop up on top and your stock should be right there. At first, I understand it can be a lot to look at. However, let's break it down. So right here, we can see it is Starbucks' chart for the daily. So it's what the stock did today from 9:30 to 4 p.m. We can see the bid, which is what buyers are looking to buy at, and the ask, what sellers are looking to sell at. And we can see the range that it had today, the volume, how it's done this year, and the dividend yield. If your stock does pay a dividend, which we will go over later in the video actually, it will be here. So how much? So Starbucks will pay 1.7% of $102 as a dividend per share. Their market cap, investment style, price when sales, beta, consensus, for this stuff doesn't matter. What we're focused on is financials. And if we click financials, it does take a little bit to load, but hopefully it'll load up. There it is. Alrighty, and now that we're on the financials page, we're going to look at the income statement. That is the first graph right under here, and we're on the annual time frame. So that'll tell us their annual releases of earnings instead of breaking it down by quarters, which would be every 4 times a year. We don't want to look at this. We want to look at annual, especially if we're investing long term. Now, the first thing we can see is there was an obvious hit in 2020 due to the events that have gone on this year. All across the board, we can see Starbucks has taken a hit. However, before that, in 2018, they went from making $24.72 billion to $26.5. And yes, they did take a hit, but hopefully in the future, we can see this increase. The next thing we're going to want to look at is their balance sheet. We want to look at the ratio of assets to liabilities. The best thing for a company is to be increasing their assets while decreasing their liabilities. An asset is anything of value or a resource that can be converted into cash for a company. Assets tend to generate revenue or benefit the company in a certain way, where liabilities are things that a person or company owe. So it's usually a sum of money that is paid off over time, and it isn't making the company money. Instead, it's losing the company money. So what we want to see is the company increase their assets at the same time of decreasing their liabilities. So with Starbucks, we can see they were decreasing their assets from 2018 to 2019, but in 2020 they really increased them with increase in liabilities. Now, this is not something that we want to see, but we want to see on a company work on this over time. And as I'll explain in a little bit, everything does not have to be perfect. But the last thing that we want to look at is cash flow. We want the company's operating expense to be decreasing and the free cash flow to be increasing. A positive cash flow provides a return to investors, and it indicates that a company's liquid assets are increasing. So as you can see with Starbucks, not everything is perfect, but it shows that the company is moving in the right direction. Now, if we pull up a stock like GameStop, I'll show you exactly what we do not want to see. If we look at financials on a stock like GameStop, we can see their revenue has been decreasing year over year at the same time as their assets, and liabilities have stayed the same and not really moved as much. If we look at this financial sheet, we can see that this company will eventually run itself into the ground if something does not change. Now that you know how to find a company and go through its float and financials, the only thing left is how to be diversified in your holdings. Now, in my opinion, there is no such thing as a perfectly diversified portfolio, but depending on your age, I would keep it simple. 50% into an index fund, 30% into growth, and 20% into more stable dividend stocks. For example, some index funds that I think as starters you can start out with is the Vanguard S&P 500 ETF, the SPDR S&P 500 ETF Trust, and the iShares Core S&P 500 ETF. I will leave these up on the screen if you want to pause the video and write these down. These are 3 index funds that are simple and easy to get into when first starting out with investing. Now for growth, it really depends on you. A growth stock is a company that generates income year over year with a positive cash flow and is expected to increase at a faster rate than the average company within the same industry. Some growth stocks that I like include Square, Amazon, Baba, and Roku. Some things that I wrote here just to show you what you should be looking for in a growth stock that I like about Square is the fact that Square's revenue has been growing at an annual 40% year over year throughout the last 5 years. A big chunk of Square's profits come from Cash App, which is a Venmo-like service that has been reporting major revenue increases, like a 212% increase this year, accounting for half of Square's total profit. I personally use Cash App, and I think it is an up-and-coming service that many people will continue to use for years to come. When looking at growth stocks, what you choose to invest into is entirely up to you. The main thing is the company should be profitable. If the company is not profitable, there is little to no chance that it will be able to outperform in its industry. One other major thing is to invest in a company that you believe will still be around and relevant in 10 years. If you are investing for the long run, you want to know how your company makes profit and if they're able to adapt to changes in society throughout the years. If your answer is yes to these questions, then your growth stock is perfectly fit for the job. And lastly are those stable dividend stocks. These are here to keep your portfolio grounded. They are less focused on growth and more paying back their investors. A dividend stock is a company who takes the profit that they earn and pays it back to their shareholders. Stocks like KO and AT&T have been doing this for many years. These types of companies aren't ideal for growth because they usually give their earnings to shareholders instead of investing it back into the business. 2 of my favorites are Coca-Cola and AT&T, as Coca-Cola pays out $1.64 per share and AT&T pays out $2.08 per share. Obviously, at first glance, this sounds like nothing, but if you're able to reinvest those dividends and buy more shares with that money, eventually, as you become older, you'll be able to live off of the dividends alone. Now that you know exactly how to manage your portfolio and what to invest in, this is where the fun part starts. Being able to go out and actually invest. Using your knowledge that you learned today, hopefully you can build up your portfolio and become an investor. If you guys gained any value from today's video, I would really appreciate for you to like and subscribe, and if you have any questions, feel free to leave them down in the comments. I also will have my Discord linked in the description, so make sure to stop in and I will be happy to answer any questions that you may have. But that is all for today. I hope you guys have an amazing weekend, and I will see you in the weekly watch list video.